Hello everyone, my name is Elliot Gu. I'm co-founder of Capitalist Times Investment Research and the Energy and Income Advisor. Today I want to talk a little bit about energy, and in particular, what's working in energy right now. Now I know a lot of viewers of this and readers of our various publications probably are thinking, energy is not performing very well. But I think the main reason why most people think energy is not performing very well right now is they're all looking at the wrong places within energy. The vast majority of individual investors I speak to, especially those who are not very interested in the energy sector specifically, if they have any interest in the energy sector at all, it's via an exchange-traded fund. The two most popular exchange-traded funds out there are XLE, symbol XLE, which is basically the S&P 500 energy index. It's the energy stocks in the S&P 500. It's market capitalization weighted, which means most of that ETF is really just two companies, which are ExxonMobil and Chevron. Those who are not invested or invested beyond XLE are often in the XOP ETF, symbol XOP. This is a SPDR E&P, exploration production energy ETF. This is not market cap weighted, it's actually equally weighted, and there's a large list of exploration and production companies mainly in there. There's some refiners as well and some services stocks as well, but most of it is exploration and production companies. And the problem is that most of the E&P companies in there are targeting primarily oil. So they're heavily leveraged to the oil industry. So the reason why most people think energy stocks aren't performing well is because the two biggest ETFs that sort of dominate investor interest in the space, many of the largest and most well-known names are in one form or another basically leveraged to oil prices and the health of the oil market. There's a lot more to energy than oil. And I'm going to show you exactly what I mean. First up, here's a chart of the S&P 500 in blue and the S&P 500 energy ETF, that's that XLE ETF I just mentioned, over the past year, since May 3rd, 2024. And what you can see here is XLE is down 8.5%, which is way worse than the S&P 500, even though the S&P 500 took a big hit back in March and early April, right? The high was actually February 19th. And we plummeted from that high to early April lows, and we've recovered some of that, but it's still up 12.3% over the last year. And so XLE, the S&P 500 Energy Index, is underperforming that. Now let's add in XOP so you can see how that's done. And what you can see here is that over this time period, the XOP ETF is actually down 21.6% over the last year. So of course, if you own one of these two ETFs, you're underperforming the S&P 500. And in one case, XOP, it's down over 21%. Now this is why Roger and I in Energy and Income Advisor and all the services that I have anything to do with, I'm always telling people, don't just buy these energy ETFs. They're terrible. There's a lot more to energy than just, first of all, a couple of big names that dominate the XLE ETF. And primarily, when you buy XOP, you're not really diversified, even though you're owning a lot of companies. You're mainly owning a lot of companies in one way or another leveraged to oil. How about natural gas? Take a look at this chart. This chart shows the S&P 500 again as a blue line. You can see it there. It's up, as I said, 12.3% over the last year. But I've also depicted on this chart three natural gas focused recommendations we make in the Energy and Income Advisor service. Also recommend some of these companies and some other services that I'm involved with. But the first is actually a natural gas midstream company. Now midstream, this is a company that owns natural gas pipelines, processing facilities, basically infrastructure used to transport, store, process primarily natural gas. And this stock is up over 13% over the past year, so it's beating the S&P 500, and it has far less volatility, less day-to-day volatility in prices than the S&P 500. It also offers a yield of over 7% annualized. So if you're into dividends, that's a great pick. Now, the other two lines that you see on my chart are actually two producers that we recommend. The first of these producers, well, that's up 25.6% over the last year, okay? So it's up more than double what the S&P 500 is over the past year, and it's up year to date. The third one, which I've just labeled producer number 2, but I'll tell you what it is. It's actually EQT, which is a name I've mentioned before on these videos. The symbol there is, not surprisingly, EQT. It's one of the largest natural gas producers in the US, and that's up over 30% over the past year. So natural gas is doing quite well, even though oil is below $60 a barrel. We've got a lot of negative headlines out there right now about oil. I tend to think that oil prices are more likely to be higher over the next 12 to 18 months than significantly lower. I think we're probably fairly close to a bottom in oil, but you know, it could scrape along here for some time to come, and a lot of these stocks aren't going to really get going until oil starts to pop back over, you know, $70, $75 a barrel again. They're not going to really work for you. Natural gas names instead, now that doesn't mean there aren't values there. I think there's some, but natural gas names are working right now, and I see a lot of upside for natural gas prices. In fact, I think actually natural gas could see a significant benefit from what's going on in the oil market right now. So let me jump in and just sort of give you a little background on why I think natural gas is actually a really defensive place to be in energy, even if there's a recession in the US and globally. So let's start with this chart. What I did here is I just looked at, this is Energy Information Administration data for natural gas use. This is a percentage of total natural gas used in various end market sectors since December 2005. And they actually have 5 sectors. The EIA breaks down natural gas consumption into 5 different sectors. Residential, which is mainly home heating, but also, you know, using natural gas, for example, in gas stoves. You have commercial, which is in orange on this chart. That's mainly business heating. And also, you know, for example, restaurants which is commercial operation, using natural gas stoves. Mainly, though, these are driven by winter heating demand for both the residential and commercial sectors. We have industrial in green, okay? Industrial includes using natural gas to produce energy to make manufactured products, but also natural gas as a feedstock in various manufacturing type industries. For example, producing fertilizers, nitrogen fertilizer, those operations use natural gas as a feedstock to produce nitrogen fertilizer. The last that you see, well, there's vehicle fuel, which is that blue line that you can barely see right at the bottom of my chart. Vehicles are not an important consumer of natural gas in the United States or really anywhere. Electric power, though, is by far the largest and fastest growing source of demand for natural gas in the United States. Back in 2013, late 2013, it was under 35% of U.S. gas demand was for electrical power generation. These are utilities using gas to produce power, to make electricity, right? And now it's upwards of 45% as of the most recent data. So electricity is the key driver of demand for natural gas. The second largest use is industrial. And then you have commercial and residential, which, as I said, is mainly heating. Now, the key thing to understand is that electricity demand is growing faster than oil demand, not only in the US, but globally. And, right, it's less economically cyclical, more recession resistant, whichever way you want to look at it. Let me show you this next chart here. What I did here is we've got all those sources of demand for natural gas. And I did this chart on a monthly basis from January 2006 through through December of 2010. So those of you familiar with this period will know that that was a period that included the Great Recession that lasted from December 2007 through June of 2009. It was one of the worst recessions of the post-war era in the US and in many foreign countries as well. But we're looking specifically at the US on this chart. Now, so it was a very bad recession. So theoretically, it should have had, if it's going to have an impact on gas demand, the Great Recession would have been, an obvious reason for gas demand to have gotten hit, right, from a cyclical basis. And what you can see here, though, is that, as I said, the residential, which is that blue line, right, the commercial demand for natural gas, those are primarily driven by winter heating demand. So you see that those spikes, they're very cyclical. It looks kind of like a sine wave there. And the top of that wave is always in the winter months because that's when it's cold in the United States. Obviously, the U.S. is in the northern hemisphere, so heating demand is highest in the winter months. But you can see, even in 2008, which was really the worst time of that recession, the winter of 2008, early 2009, you can see that in those years, residential and commercial demand for natural gas actually held up really well because, again, it was driven by weather conditions in those winters, not the economy. The purple line is electric heating demand, or demand for gas from the electric power sector, and that's highest in summer because it drives summer cooling demand. Air conditions run on electricity for the most part. And what you can see there is the summer of 2007, we saw a big spike in natural gas demand from electricity power generators. 2008 was kind of weak, but that was primarily because it really wasn't a particularly hot summer that year. By 2009, 2010, electricity demand in those summers had recovered. So really not a lot of cyclicality there. The only source of gas demand that is a little bit cyclical, and you can see it in 2008, is that dark black line, which is industrial demand for gas. And as you can see, it did kind of slump somewhat in 2008 and 2009 when the economy was at its weakest, but then it recovered quite nicely in later in 2009 and into 2010. So the most cyclical source of demand for gas is industrial demand, but even that's not particularly cyclical. Take a look at my next chart. Same period. I took this back to December 2005, and I took it a little farther into the future, up till late 2017. What I'm showing you here is overall oil demand, all the petroleum products. So that's oil, gasoline, everything made from oil. And also the demand for natural gas during that same period. And what you can see is there was somewhat of a slowdown in natural gas demand. That's that orange line during that 2008-2009 period, but it very quickly recovered, and it was a very mild decline in demand for natural gas compared to the big hit we saw in oil. It also took oil demand, petroleum product demand, much longer to recover. It really didn't recover until 2015, 2016, and that was mainly because oil prices finally came down after late 2014, and that encouraged more demand for oil. So again, natural gas demand, not very cyclical. So if we do see a US or global recession, I expect natural gas to be a lot more defensive than oil because demand is driven by things which are less cyclical, like electricity demand. Now let's look at electricity demand versus oil demand on a global basis on this next slide. This slide, oil demand in orange, electricity demand in blue from 1985 up through 2023. This data is from the Energy Institute Statistical Review of World Energy, which comes out every year in June. So what can you see here? Again, that orange line, we did see a dip in 2008. We saw an even bigger dip in oil demand in 2020, very temporary, but it bounced back relatively quickly. But there was somewhat of a slowdown during those cycles, because oil demand is primarily driven by transportation demand, things like freight transportation. And this is on a global basis, by the way, as I said. But look at electricity demand. Very little dip at all in 2008, very small, some dip, but not much. And again, in 2020, a little bit of a flattening out in electricity generation globally, but then it very quickly recovered. In fact, if we look at the period from 2009 up through 2023, so that's the end of the Great Recession up through 2023, on an annualized basis, global oil demand grew at about 1.28%. Global natural gas global electricity generation grew at a 2.82% annualized pace. So considerably faster. So again, based on this chart, based on the growing importance of natural gas in electricity generation, both in the US and globally, I expect natural gas demand to see much less of a hit from an economic slowdown or global recession than oil. And so it's much more defensive. And one of the major reasons that oil prices have been coming down, I think, is because of concerns about global demand. There are also some supply concerns. I'll have to address that in another video. I think those are overblown, but I'll have to address those in another video. But at the same time, one of the primary concerns has been demand and the potential for there to be a recession in the US and globally, which could hit oil demand. And it is much more of a concern for oil relative to natural gas. So let's move on to why I think the decline in oil prices might actually be something bullish for US natural gas prices in particular. One of the biggest issues with the new US natural gas market in recent years has been a lot of US natural gas production isn't driven by the economics of natural gas, right? What I mean by that is a large portion, 30% plus of US natural gas supply over the long haul has actually come from what's called associated natural gas. And that is natural gas that's produced from oil wells. So these are wells right now primarily in the Permian Basin of Texas and New Mexico that are targeting oil, and the natural gas is produced as kind of a byproduct of that production. So the economics of these wells is primarily driven by the oil they produce. That's what the producer is going for. But these wells also produce significant volumes of natural gas as sort of a byproduct. So natural gas supply can increase when the economics for drilling for oil are strong. Even if the economics for drilling for natural gas are weak, you can still see an increase in natural gas production. And it's not because US producers are stupid and they're drilling more natural gas when prices are low. It's actually because you have oil producers that are producing significant volumes of natural gas as a byproduct. Let me show you this chart. This chart actually shows the 3 largest shale fields in the US in terms of natural gas production. You can see the Marcellus Shale in green is the largest in the United States. This is primarily a natural gas play. It's the lowest cost natural gas field in the United States. It's located in Appalachia, centered on states like Pennsylvania, West Virginia, parts of Ohio. It's the lowest cost play in the United States. Some producers like EQT can actually break even with gas prices down around $2 a million BTUs. The blue line on my chart is actually the Permian Basin. And these are primarily oil wells that are producing natural gas, associated natural gas as a byproduct of oil production. The third largest play is the Haynesville Shale, which is centered on Louisiana, but also includes parts of eastern Texas. This is also a gas play. Very little oil or liquids volume produced with natural gas in this region. The field's too deep for that. It's very high pressure and deep. So it's a little higher cost play than the Marcellus Shale of Appalachia. You probably most producers there probably need natural gas more like 325 a million BTUs to produce any kind of free cash flow from wells there. So, and that's the orange line. So what you can see here is that the Marcellus Shale production there has been pretty steady since 2020. There have been a little bit of an increase at times, such as in late 2023, which was in response to, in late 2022, which was in response to high natural gas prices of that era. But generally speaking, production has been kind of flat, and it hasn't fallen much even when gas prices were weak. The main reason for that is that, as I said, producers there can make money even with very low natural gas prices. So it's a play where even at very low prices, it's going to produce positive free cash flow for most producers in the play. So they're going to keep producing at a higher level than, say, a producer in the Haynesville Shale, which is that orange line, which is losing money not producing free cash flow at low natural gas prices. So you can see there, for example, the decline in Marcellus production after late 2022, the peak in natural gas in this cycle, was much smaller than for the Haynesville Shale. But the Haynesville Shale came down much more because producers there cut back on drilling much more because they can't make money with gas at $2.50, whereas some producers in the Marcellus can do. The blue line, though, that's the Permian Basin. Now, that continued to grow into 2023, 2024, and early this year because the economics of that play are driven by the economics of producing oil, not natural gas. In fact, you can see the only times where Permian natural gas production has declined were periods where oil prices came down, like 2020, or back in 2015, 2016, gas production from the Permian flattened out because oil prices were relatively low there, and producers in the Permian were cutting back on drilling activity, lowering their oil production, but also lowering their associated gas production as well. So one of the things that's happening right now is we have oil prices below $60 a barrel, WTI. We have natural gas prices that have been up over $4 a million BTUs, the highest we've seen in a long while at points here in 2025. The natural gas calendar strip for 2026 next year is over $4 a million BTUs. That's a very attractive price for producers in the Marcellus, in the Haynesville, even everywhere. So we're seeing the Haynesville production actually begin to tick higher in response to those higher natural gas prices now. Marcellus shale production is steady, as it's been for a long time. So what I think you might actually begin to see, though, is Permian production flatten out or roll over of natural gas. The reason for that is Permian producers are cutting back on their drilling activity, on their production activity in response to lower oil prices. Shale production of oil is flattening out, and I think you're going to see that accelerate the longer oil prices remain down in the high 50s, low 60s range. Until we get back up to, as I said, $75 or $80 a barrel, I don't think you're going to see a big increase in Permian activity levels. So that's actually bullish for natural gas because it means lower production of associated gas over time, which means the market's going to rely more on actual shale gas plays to meet U.S. gas demand. And really what that means is that with Marcellus production kind of flat and also limited by the amount of pipeline capacity out of Appalachia, I think a lot of the increase in gas production to meet growing demand is going to have to come from the Haynesville, which is the swing supply of natural gas. It's a gas-focused play. But the economics there, again, you need to see gas prices north of $3.25 and really more comfortably around $4 or higher to incentivize gas production out of the Haynesville. And so that's where I think we're going to see gas prices have to kind of average out in that $4 million BTU plus range in order to incentivize production from the Haynesville shale, because that's what they need there to produce gas profitably. Last slide I want to show you today, U.S. LNG exports. Something I've talked about before on these videos. LNG is liquefied natural gas, if you're not familiar with it. It's just gas that's super cooled, loaded onto specialized tankers, can be transported anywhere around the world. U.S. LNG exports are driven primarily by capacity. In other words, the amount of capacity the U.S. has to export natural gas in LNG form. Here's the chart. This shows U.S. liquefied natural gas exports in millions of cubic feet a day. Right now, the latest data we have, we're getting up over 13.5 billion cubic feet of U.S. LNG exports, which is near a record high. The reason that we're seeing a surge into early 2025, the latest data we have is for January, is we have a number of new LNG export terminals coming on stream between late last year, late 2024, and early 2026. And in fact, a couple of these facilities, believe it or not, are actually opening up ahead of schedule. So we're seeing a rapid ramp in U.S. LNG exports because these new terminals are opening up, allowing more LNG to be exported. Between the end of 2024 and early 2026, we're seeing about 4 billion cubic feet a day of new LNG export capacity coming out of the US alone. So I think you're going to see a big increase in demand for US gas because of this export demand. As you can see here, again, 13.5 billion cubic feet a day now, growing up by 4 billion cubic feet between late last year and early next year. So there you have it. Not only is our natural gas stocks actually performing well, while most people obsess over oil and the S&P 500 Energy Index and these ETFs that basically track a bunch of stocks levered to oil, natural gas is sort of this quiet bull market. I think it's much more defensive in the event of recession. The growth in LNG exports is almost baked into the cake because of all this new capacity coming on stream. Did I mention that the stocks are actually working? One of our producer picks, EQT, is actually up more than 30% over the last 12 months, even with the S&P 500 Energy Index down, that XOP ETF down more than 20% over the last 12 months. This is up 30%, outperforming by 50 percentage points. So if you take nothing else away from this video, take away this. The idea is that if you focus only on the ETFs or the big indices that they talk about on financial television, like the S&P 500 Energy Index or that XOP ETF, you're probably going to be disappointed with how energy is performing, because all of those are levered to the oil market. For some time now, we've been saying in Energy and Income Advisor that our favorite market within energy is actually natural gas. We've called repeatedly 2025 the year of natural gas. If you're in the natural gas stocks, you're actually feeling pretty good right now. Even the midstreams, which is considered a lower volatility way to play it, are dramatically outperforming the S&P 500 and offer a nice yield as well. So if you're interested in finding out more about the natural gas plays we're recommending right now in Energy and Income Advisor, both the high yield midstream names as well as the producers, and possibly some new additions we're looking at here over the next few months, then check out the link below this video. We actually have a special offer running for risk-free trials to Energy and Income Advisor right now. Try the service for 60 days. If you don't like it for any reason, cancel for a full refund guaranteed. So again, I hope you found this useful. Hope I didn't bombard you with too many charts in this quick video. But that is, I think, one of the most exciting bull markets we see, bar none, in the stock market right now. Natural gas focused plays in energy. Again, my name's Elliot Gu. Thanks for listening.